A few years ago, you may have checked your investment app a dozen times a day, only to discover that watching every small move increased anxiety instead of confidence. News headlines followed you into the night and greeted you in the morning, turning money into a source of volatility rather than peace of mind. Every week seemed to bring a new opportunity that promised a shortcut, and your time horizon quietly shrank from years to days. Seeing other people post bigger gains can make anyone feel behind, but comparison often hides the risk and drawdown that never appear on screen. The people who look busiest chasing wealth are often carrying the heaviest pressure, while quieter builders focus on compounding instead of attention. The difference is rarely intelligence or luck. It is the mindset that treats money as a long-term tool rather than a daily scoreboard. Welcome to The Margin, where we explore how money, psychology, and modern life intersect beneath the surface of everyday decisions. Today, we explore the signs that you may have outgrown financial hype and started building real wealth through patience, resilience, and long-term thinking. Modern finance is remarkably good at selling dreams, and every day there seems to be a new story about someone getting wealthy faster than everyone else. Those stories feel irresistible because the human brain naturally prefers a shortcut that appears to shrink the distance between effort and reward. The problem is that fast-looking wealth often hides risk beneath the surface, and hidden risk usually creates the most painful drawdowns. Many people enter investing to build a future, but over time they accidentally become collectors of excitement instead of long-term progress. Without noticing it, the focus shifts from a consistent process toward predicting outcomes that nobody can reliably control. Ironically, consuming more financial information often makes decisions harder because too many choices create mental volatility of their own. That is why many investors stay busy every day while feeling no closer to their actual long-term destination. Eventually, there comes a moment when people begin questioning the cycle, and that moment often becomes an important turning point. They begin realizing that chasing every opportunity is not a strategy at all and may simply be fear of missing out wearing a smarter disguise. Once that realization arrives, the entire definition of wealth changes, and the real journey of long-term compounding can finally begin. The first sign is that you stop searching for shortcuts because you finally understand that wealth is mostly a function of time horizon, not speed. The question shifts from how to get rich faster to how to stay consistent through volatility for decades. That small change sounds simple, but it can completely alter the direction of a financial future. The second sign is caring more about risk than potential upside, even when that sounds boring to everyone else. Most major investing losses begin with ignored risk rather than a shortage of opportunities. Mature investors focus less on what they could gain and more on what a drawdown could take away. This is not pessimism. It is simply the mindset required to survive long enough for compounding to matter. In investing, staying in the game often matters far more than occasionally hitting a spectacular win. Once protecting capital becomes the priority, decisions usually become calmer and less emotional. And that calmness is often a stronger sign of financial maturity than the size of any portfolio. The third sign sounds strange at first. Investing no longer feels exciting because your focus has shifted from daily volatility to long-term progress. There is no longer a need to check prices every few minutes because your time horizon has become more important than every small market move. Many people think boredom is a problem, but in long-term investing it often means your system is working exactly as intended. Warren Buffett built much of his wealth through extraordinary patience, allowing compounding to work over decades rather than chasing weekly trends. That reality often disappoints people searching for a secret formula because wealth is frequently built through ordinary habits repeated for a very long time. The fourth sign is that you no longer feel obligated to participate in every new opportunity that appears in the market. When everyone is talking about the next big thing, social pressure can make missing out feel more painful than taking unnecessary risk. Mature investors eventually realize that not every opportunity matches their goals, risk tolerance, or long-term plan. They stop measuring success by trend participation and start measuring it by their ability to stick to a plan during volatility and drawdowns. One of the most valuable returns is rarely visible on a statement, the peace of mind that comes from trusting a long-term process. The fifth sign is simple. You start valuing reliable cash flow more than impressive numbers flashing on a screen. Years ago, portfolio gains felt exciting, but now daily financial stability matters far more than temporary volatility. After all, bills are paid by income and cash flow, not by unrealized gains captured in screenshots. Consider an office worker who invested automatically every month for years without any dramatic story to tell. He never became internet famous and never appeared in stories celebrating overnight success. When an economic slowdown arrived, his routine remained intact, and that resilience became his advantage. Stability rarely looks impressive from the outside, but it feels remarkably valuable when you live it. Many people chase the next big jump, while fewer people spend years building a durable foundation. A strong foundation protects a house during storms, and the same principle applies to personal finances. Real wealth often appears ordinary until a difficult period reveals how much strength was quietly built over time. The sixth sign is that you stop trying to outperform everyone else, and that shift often feels surprisingly freeing. Early on, many people treat investing like a competition where every result must be compared with someone else's score. Over time, that game becomes exhausting because there is always someone with a larger portfolio, higher income, or faster gains. Comparison has no finish line, which makes it one of the easiest ways to drain attention, energy, and peace of mind. Mature investors eventually choose a different game, one that values long-term progress over social victories. Instead of chasing status, they focus on personal sufficiency, a goal that is often healthier and easier to sustain. When your definition of success becomes personal, much of the pressure created by outside expectations starts to fade away. You do not need to be the world's best investor. You only need an approach that fits your own life, risk tolerance, and time horizon. That realization sounds simple, yet many people spend years learning it through experience, volatility, and changing priorities. And for many people, that is the moment when money stops being a permanent source of stress and becomes a tool for living. The seventh sign is that your focus slowly shifts from money to time, and that changes how you measure wealth. Early on, the numbers feel like the finish line because more income seems like the answer to every problem. With a longer time horizon, you start asking what wealth actually buys instead of how impressive it looks. The answer is often not possessions, but the freedom to choose without constant financial pressure. Financial stability creates the option to walk away from work that damages your health or peace of mind. It also creates room for family, recovery, and ordinary moments that volatility in life often interrupts. At that point, investing stops feeling like a scoreboard and starts feeling like a tool for breathing room. In a world packed with deadlines and notifications, breathing room becomes surprisingly valuable. Financial maturity often means realizing that time cannot recover from a drawdown, while money can. Maybe the most honest definition of wealth is having greater control over how you spend your days. At some point, success stops looking like a portfolio number and starts looking like a life that feels easier to manage. A market drawdown may still happen, but sleeping well through volatility becomes its own form of progress. Real discipline often appears when every new opportunity no longer feels like an urgent decision. The strongest long-term strategy is often simple enough to repeat through changing markets and changing decades. The world constantly advertises fast outcomes, while quiet financial stability rarely gets a marketing campaign. Many people chase wealth hoping to find peace even if they rarely describe the goal that way. Compounding usually works quietly, which is why real wealth often grows without much attention or drama. The goal is not impressing strangers, but creating a life that feels safer for the people who matter most. Once priorities align with a longer time horizon, much of the surrounding financial noise loses its influence. In the end, wealth is often the result of simple actions repeated consistently through time, risk, and uncertainty. Real wealth may not show up as a bigger lifestyle, but as a quieter mind when volatility and uncertainty appear. Financial maturity often looks less like finding secret opportunities and more like ignoring distractions that compete for your attention. In the long term, wealth is not only what sits in your accounts, but also what no longer occupies your thoughts every day. If this feels familiar, you may be entering the stage where money becomes a tool instead of the destination itself. Some of the most important progress in personal finance happens quietly without attracting attention from anyone else. At the margin, we focus on understanding money through real-life, risk, and long-term decisions rather than hype. What do you think is the clearest sign that someone has stopped chasing financial hype and started thinking long-term? Is the turning point avoiding quick gains or finally deciding what enough means for your own life and time horizon?